Yeah, so we can, in this case, finalize on that part you actually attempted as an assignment. So we were to look at the second part, which in this case required us to come up with an extract of the statement of financial position. So in this case, we have 𝐵𝐺𝐻 Limited, 𝐵𝐺𝐻 Limited statement of financial position extracts. Statement of financial position extracts, and of course it is for as at 31st of December. It is for the year 2006, 2007, and of course 2008. So this one is actually in shillings of thousands. Shillings of thousands. These shillings of thousands, yes. So this one is in shillings of thousands. This one is also in shillings of thousands. Shillings of thousands. And therefore, we said the first item, in this case, we need to be able to determine. It is what we call the work in progress, where in this case, you start with the cost to debt. We start with the cost to debt. Cost to debt. This one is ideal in this case in the previous income statement you've already been able to prepare. So in this case, we had 20 million, 62 million, of course, 94 million. So you have in this case 20 million, 62 million, and of course 94 million. So then on this one, we said you'll likely end up having to add the gross profit realized to debt. The gross profit in this case realized to debt, gross profit realized to debt. Add gross profit to debt. This is basically the gross profit that in this case has actually been realized in each and every year in the income statement. So if you look at the first year, it was actually in this case 6.4. It was 6,400,000. This one was 13,600. Then the other one, it was 26 million. It was actually 26 million. 26 million. Then on this one, you can, in this case, less cash received to debt. So you less, in this case, the cash, less cash received to debt. The cash received to debt. If you look at the question, in this case, you've actually been given the collection from clients for the different years. Collection from the clients for the different years. So in the first year, they have given you 12, then 38, then it is actually what, 60. So in this case, the first they have actually given in this case 12, then 38, then of course now in this case what, 60. So remember, it is actually to debt. These were some of our friends were missing out a bit. So it is supposed to be to debt. The money collected cumulatively over the years to debt. So in the first year, in this case, they were able to collect 12 million. They were able to collect 12 million. So in this case, it means in this year, we'll be able to take, in this particular year, we'll be able to take 12 plus, in this case, that amount of 38. And therefore, in this year, we'll likely be talking about 50 million. Then in the very, very final year, they were able to, in this case, cumulatively add on 60. And this year, we are having to talk about what, 110 having been collected. So that's basically how you get what, to debt. So these were some of our friends who are missing out, but that's in this case how you get it. You basically get to debt because what you've actually been given in the equation is just the collection for the specific year. But in this case, you need to get to what, to debt. So you can actually be able to, in this case, do the computations there. Do the computations there. And of course here, you should be able to get 14,400. I think it is 14,400. 14,400. Then this one you can do 62 plus 13,600. That is 75,600 minus 50. So it means it's 25,600. 25,600. Then this one is 94 plus 26. You get in this case 120. And therefore in this case you should be able to get here 10,000. 10,000. You should be able to get here 10,000. So that's, in this case, will likely be what will be the work in progress. This one is the work in progress. Work in progress. Work in progress, or basically the WIP. So in this year, they carried forward work in progress of 14,400,000. In this year, they carried forward work in progress of 25,600,000. And in this year, they carried what, 10 million. Is the work they have, is like an asset. So in this case, they still basically depend upon it to do in the coming year for them to generate even what, more revenue. So this one, they carried it to this year. This one, they carried it to this year. Then in this case, eventually they were having to close with a work in progress after the end of the entire project of how much? 10 million. Then we can, in this case, determine whether we have an accounts receivable or accounts what? Payable. An accounts receivable, in this case, what? Accounts payable. And in this case, we said you need to take the total billings or invoicing. So the total billings, or what has actually been invoiced to the clients, total billings or invoicing, what they have actually been able to bill the client to be able to pay. That means is the money the client is having to owe them as contractors. So in the first year, you've actually been told the billings to the clients, it is 30 million, 50 million, and of course, what, 40 million. So total billings to the client, it's supposed to be to debt, also. So total billings to the client to debt, it's supposed to take to debt. So in this case, what was actually billed to the client in the first year it is actually, in this case, 30 million. It is 30 million. It's 30 million. Then in this case, in the second year, they billed 50 million. So cumulatively, that will likely end up having to come to 80 million. It will likely come to 80 million. It will come to 80 million cumulatively. It will come to 80 million. Then in the final year, they actually billed how much? 40 million. So in this case, cumulatively, it will come to 120 million. So the total billings or invoicing to debt. So it's supposed to be to debt. Then in this case, you can actually be able to minus now what was actually received, what has actually been received to debt. So less the cash received to debt. The cash received to debt. This is basically, in this case, this amount here, the 1250, and of course, what, 110. So in this case, it's actually 1250. And of course, in this case, 110. So it's actually supposed to be to debt. What has they have already been able to receive to debt up to now, up to the particular point in time we're having to account. So you less, in this case, this one you'll likely be able to get, it is actually 18 million. This one is 30. When you take 80 minus this, you get 30 million. Then in the very final year, you'll have, in this case, 10. So you likely have 10. So this is now the figure for what? For accounts receivable. Some of you are forgetting to write this. You're supposed to write accounts receivable. So because all of them are actually positive, they are all accounts receivables. They are, in this case, what this is what they're having to claim from the client. If you look at, in this case, what you've actually been able to present here, there's something you'll be able to realize. There's something you'll be able to realize. So there's something you'll be able to realize. So Joshua, you can be able to see this figure is same as this figure. You can be able to see this figure is same as this figure. So they had a work in progress by the end of the year 2008, which means they carried this work maybe forward to the year which was not within what the contract. So it means for this amount, they were not paid. So it is a receivable. Sawa. So the figures are the same. So they carried forward this work. They didn't do it by the end of 2008. They were never paid for it. So it means this amount was never gotten from the client with regard to what? The contract price. So this amount they didn't receive because it was still work in progress. It becomes what? An accounts receivable. So you can see the figures are the same. That's what you'll be able to discover there. You can see 10, 10. The WIP at the end of the final year, it is 10. They never carried out this work. So they never claimed from the contract price. And therefore, it means the accounts receivable, what they have not been able to get from the client by the end of the 3 years is actually 10 million, which is basically same in that regard, So we can look at another illustration. Let's look at another illustration so that we can see how you can actually be able to solve. Let's look at another illustration. So illustration 2. We can look at illustration 2. Illustration 2. So let's look at illustration 2. Illustration 2. So you can write it. You can write the illustration so that we can be able to look at it. So illustration 2. Illustration 2. Illustration 2. So you can say on 1st of January 2014, on 1st of January 2014, on 1st of January 2014, 𝐿𝐿𝐻𝐿𝐿𝐻𝐿𝐻 Limited was awarded a contract. 𝐿𝐻𝐿𝐻𝐿𝐻 Limited was awarded a contract, was awarded a contract on 1st of January 2014. 𝐿𝐻𝐿𝐻 Limited was awarded a contract for the construction, was awarded a contract for the construction of a road, the construction of a road. The contract was for 3 years. The contract was for 3 years. The contract was for 3 years. 3 years. 3 years. And the contract price was, and the contract price, and the contract, and the contract price, and the contract price was, and the contract price was 250 million, was 250 million, and the contract price was 250 million. The following information has been extracted from the books of the company. The following information has been extracted from the books of the company. Has been extracted from the books of the company. From the books of the company. From the books of the company. The following information has been extracted from the books of the company. So we can have in this case the different years. So we have in this case 2014, because it started in 2014 for the next 3 years, then 2015, then you have 2016. So 2014, 2015, and of course in this case what 2016. So the total costs incurred to debt. So the total costs incurred to debt. The total cost incurred to debt for, it was in this case 80. So the figures are actually in this case in millions. The figures are actually in millions. So you can say in this case shillings in millions. So shillings in millions. The figures are actually in millions. The shillings in millions. Shillings in millions. So the figures are in shillings of millions. So for this particular facet, it was actually 80, then 170, then 220. Then you have in this case estimated additional costs. Estimated additional costs. Estimated additional costs. Then billing made during the year on the contract. Billing during the year on contract. Billing during the year on contract. Billing during the year on contract. The billing during the year on contract. So this one is estimated additional costs. This one is estimated additional costs. So estimated additional cost. Estimated additional costs. So we have in this case, this one is 120. This one is 90. This one we don't have. We don't have. Then in this case, you have billing during the year on the contract. So what was actually billed during the year on the contract. In this case, we have 90. We have 100. And we have 60. Then we have cash received on the contract in the year. Cash received on the contract in the year. Cash received on the contract in the year or during the year. Cash received, what was actually received as cash on these contracts in the year, it was actually 80, 90, and of course 70. 80, 90 million, and of course 70 million. Then general admin expenses. General admin expenses. So it was 4 million, 6 million, and of course, 5 million. So like that. So the total cost is cost incurred to debt, estimated additional costs, then billing during the year on the contract, then cash received on the contract in the year, then general admin expenses. Then we have in this case what? The required. You have in this case what? The required. You have in this case what? The required. The required. You can write the required. What are we required to do using these figures? We have in this case the required. We have the required. You can be able to say, using the percentage of completion method, prepare using the percentage of completion method, using the percentage of completion method, prepare, using the percentage of completion method, prepare. What are we required to prepare? Number one, income statement extracts, income statement extracts. Number two, statement of financial position extracts, statement of financial position extracts. Statement of financial position extracts. So that's what you are required in this case to do, what? To prepare. So you can in this case copy. Then once you are done, you write there done. Then we can start having to look at it. You can write there done. Then we can start having to look at it. I can see done. I can see people are saying done. So in this case, we can start having to look at how you can be able to prepare. So we're just going to use the same concept. Same concept we've learned about, in this case, how you prepare the income statement and how you prepare the statement of financial position extracts. Just the same concept. For more practice, just the same concept. For more practice, just the same concept. For more practice, practice makes perfect. The more you practice, the more you perfect. The more you end up having to cram the format, the more the format sticks in your head. So practice makes perfect. So in this case, you can actually be able to start with the income statement extracts. You can actually be able to start with the income statement extracts. So income statement extracts. So we can have 𝐜𝐿𝐼𝐻 Limited. It is 𝐜𝐿𝐼𝐻 Limited. 𝐜𝐿𝐼𝐻 Limited income statement extracts. Income statement extracts as at 31st of December. So of course it is for 3 years. So we have in this case 3 years there. We have 2014. We have 2015. We have in this case 2016. We have 2016. So you need in this case to indicate what you are dealing with. You are dealing with shillings of millions. So they are not cows for compulsory vaccination. It is shillings of millions. These are not cows you're dealing with. So someone can only be able to know it is shillings of millions when you put them here. If you don't put, someone assumes it is cows for compulsory vaccination. So, and in this case, you're not having to deal with cows here. So we'll start in this case by having to look at the cost to date so that you can be able to see the percentage of what? Of completion. So what is the cost to date for the first year? What is the cost to date for the first year? It is 80. What about the second year? The second year, I can see you're saying 250. Others are saying 170. So Daniel, is it 250 or 170? 250, Titus says 250. There's a difference here with what we did with our previous question. In our previous question, it was reading what? Cyprian, in our previous question, what was this item in the question reading? It was what? Cost incurred. And in this current question of ours, it is reading what? Cost In the previous question, it was reading what? Cost incurred. In this question of ours, it is reading what? Cost. It is reading cost to date. It's reading cost to date. So there's a difference. So in this case, it means we'll just be able to pick the figures the way they are directly, because you've actually been given what? The cost to debts. Remember in the previous question, it was reading cost incurred, not cost to debt, but cost incurred in each and every year. But already in this case, they have already been able to accumulate here. So it means in this case, we'll have 80, 170. So that's what the examiner sometimes can trick you. So you have to be far much smarter than the examiner. You shouldn't actually confuse you with such small terms. You have to, in this case, show the examiner that in this case, at least, you are a financial reporting expert. So in this case, you have additional costs. So for the first year, you've actually been told they were able to add on 120. This one, they added on 90. In this year, they didn't add on anything. So we have in this case, what? The total cost. Total costs, we'll be able to get the total cost there. So in this case, here it will likely be 200. This one, it is 260. 260. This one is actually 220. 220 is actually 220. So we can, in this case, calculate the percentage of completion. We can, in this case, be able to, from this, you can actually be able to get the percentage of what? Of completion. So you can get the percentage of completion. Percentage of completion. In this case, we said, how do you get it? You'll take, in this case, this one, cost to debt. It is ideal, in this case, cost to debt. You divide by the cost to debt here, you divide by the total cost. The total cost. It will be able to indicate to you in this case what percentage in this case they were able to, in this case, complete in each and every year. So which average percentage they were able to complete in each and every year. So it means in this case, for this first one, we'll in this case take 80. It will be 80 over 200 times 100%. So this one is likely be 170 over 260 times 100%. This one will likely be 220 over 220 times 100%. Which percentage do you get here? You can give me the percentage here. 80. It is 40. 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 I can see you are saying 40. Daniel 40. Mercy 40. The eyes have it. The eyes have it. The eyes have it. This one is 40%. What about this one? What about this one? Mercy. 65.38. You can be able to round it off. Just say 65%. 65%. This one, do we need to calculate it really? Do we need to calculate it really? This one is what? 100%. The project was actually completed here. So it is actually going to be 100%. 100%. So that is what will happen there. So we have 65, then that. Then in this case, once we have the percentage, in this case, we can actually be able to get the revenue recognized. In this case, we can be able to get the revenue recognized. So with these percentages, we can in this case get what? The revenue recognized. So revenue recognized. Revenue recognized. Revenue recognized. To get the revenue recognized, you said you'll take these percentages, you multiply with what? You take these percentages, you multiply with what? Mercy. To get the revenue recognized, tulisema unachukua hiyo percentage of completion of the contract, you multiply with the contract price. And of course, you've actually been told the contract price is how much? The contract price you've actually been told is how much? It is 250. So that is the entire amount they'll get after the end of the contract. But of course, hiyo pesa contractee hata walipa yote mara moja. Atakuwa anawapea tu kadoz kidogo kidogo. Kadoz kidogo kidogo, like that. So in this case, it means in that very first year, so they likely end up having to get what? 40%. So they'll get in this case what? 40%. It'll likely be 40%. 40% multiplied by 250. 40% multiplied by 250. This one will likely be 65% multiplied by 250. Then in this case, this one will be 100% multiplied by 250. So 40% of this you get. 40% of this you get 100. You get 100. You get 100, so this one will be 100. So this one will be equal to 100. This one will be equal to what? 65% of 250. 65% of 250, you get Angela, Cyprian. You get in this case 163 or 165. Is it 163 or 165? You get 162.5. So we can say 163. Maybe you can say 163 or 162.5. So which one do we use? Which one do we use? So let's use 163. So because most of you are having to like that figure, let's use 163. Most of you are liking that figure. Then this one is likely be 250. 250. So like that. 250 like that. 250 like that. Then in this case, on the revenue recognized, we said in this case you add what? You add what? On the revenue recognized, you less what? You're supposed to less, not to add. You less the cost to debt. You less the cost to debt, which in this case it is these figures. It is those figures. So it is actually 80. It is 170. It is 220. 220, like that. So in this case, we should be able to get the gross profit or loss. We should be able to get the gross profit or loss, gross profit or loss, gross profit or loss to debt. The gross profit to debt should be able to get the gross profit to debt. So the gross profit to debt, gross profit or loss that was realized up to that particular debt. So in this case, here it will likely be 20. Here it is a negative 7. It is negative 7. It is a loss. It is a loss they made there. Then this one is actually 30. This one is 30. This one is 30. This one is 30. So on the revenue recognized, you less the cost that have actually been incurred to get what? The gross profit, or you can end up having to get a loss that was realized up to the end of each and every year. Up to the end of each and every year. So the gross profit or loss to debt, gross profit or loss to debt, gross profit or loss to debt, loss to debt. This one is to debt like that, to debt like that. Then in this case, we said on this gross profit to debt, you need in this case to add on, or less in this case, the gross profit already recognized, the gross profit already recognized. So less GP already recognized, You less in this case, the gross profit already recognized. I don't know whether you can be able to see there. It means you cannot be able to see there. So let's just move it. Let's just move it up here. Let's just continue with the table up here. Let's just continue with the table up here. So on that figure, you need to, in this case, to less the gross profit already recognized. So less GP already recognized. GP already recognized. So for this particular first year, because there was no 2013, it is a dash. But now in this case, for this second year, it is actually in this case what? 20. So you less in this case 20. For this particular third year, you pick the one for this year, which is actually in this case negative 7, which in this case is actually negative 7, which in this case is actually negative 7. So you less negative 7 like that. So with that, you can actually be able to get the gross profit for the year. You'll get the gross profit for the year. So you need to eliminate the gross profit already recognized. This one you pick for the previous year. For 2014, because you don't know for 2013, there's no 2013 here, so it will be dash. For 20, in this case, 15, you pick the one for the previous year, which is 2014. You place it there. For 20, in this case, what? 16, you pick the one for the previous year, which is this one. You place it there. You less from this figure. Remember, the table is continuing. So don't, in this case, rub like the way I've rubbed or move somewhere else, you start another table. No, just continue there. It's because I've seen you cannot be able to see here. That's why I've moved the figures up, but continue with the table. So this means we're having to less a dash here. We're having to less this one here. We're having to less this one here. With your table, you just continue. You just do what? Continue. So we can, in this case, be able to get now what? The gross profit for the year. So the gross profit for the year. So we'll be able to get those figures. We should be able to get those figures. So it means here we'll take 20 minus a dash, which in this case it will likely remain to be what? To be 20. It will remain to be 20. Then here we'll take this negative sum. We minus in this case again what? 20, which in this case will give us a further negative, and it will come to what? 27, negative 27. Then on this other one, it will likely be 30 minus minus. So it is 30 minus minus, 30 minus minus. So it will likely in this case be 30, you minus minus 7 like that, minus minus 7 like that. So here it will become a positive. So it will likely end up having to be what? 37. It will be 37. It will be 37. So this one is you minus a negative. So it is minus minus. In mathematics, you'll be told when you have two negatives, they give you what? A positive. So it will come to, in this case, what? 37. So like that. It will likely come to 37 like that, 37 like that. Then we can less now what? The admin expenses. We can less the admin expenses. We can less the admin expenses. So less admin expenses. We can now less admin expenses. Admin expenses. These ones you just take the way you've actually been given directly. So you have actually been given 4, you've been given 6, and you've actually been given, in this case, 5. You've actually been given 5. You've actually been given 5. So in this case, with this, you can actually be able to get the net profit. You can actually be able to get what? The net profit. So this one is actually 16. Is actually 16. This one is negative 33. Negative 33 is actually negative 33. This one is actually 32, 32. It is 32 like that, 32 like that. So of course that is what, those are the net profits. Those are the net profits. Those are the net profits. Those are the net profits like that. The net profits like that. So that's why in this case you would have actually been able to come up with what? The income statement extra. So of so much importance, John, of so much importance, just be able to remember the format, how we basically go with the format. The cost to debt, add additional estimated costs. You get the total cost. With that, you can get the percentage of completion. With the percentage of completion, in this case, you can actually be able to know how much revenue was recognized in each and every year. Then in this case, you less the cost to debt, you get the GP or maybe the loss. Then in this case, you end up having to also deal with the gross profit already recognized. Then you'll get the gross profit for the year. Then you can be able to less what? The admin expenses, to be able to get what? The net profit realized in each and every net profit or loss. It can actually be net profit, or in this case, what? Loss. Because in this case, you can actually be able to see in this particular year, it is not a profit, it is a loss. It can be the net profit, or it can actually end up having to be what? To be a loss. It can actually end up having to be a loss. It can end up having to be a loss. So we can, in this case, come up with what? The income statement extract. So let's see the income statement extract. Sorry, the statement of financial position extract. Statement of financial position extract. So statement of financial position extract. So statement of financial position extracts. Statement of financial position extracts. Statement of financial position extracts for those years. So in this statement, we said we start with what? We said we start with which figure? Which figure do we start with? I can see someone has not gotten those figures. He's asking gross profit for 2015. It was negative 27. It was negative 27. Negative 27, negative. Then someone is asking, is it gross profit or a loss? It depends. So you can either get a loss or a profit. So if it is a profit, it is normally a positive. If it is a loss, it is a negative. So it will depend. In that year, you're having to see a negative. It means in that year, they got a loss. In that year, you're having to see is a positive. That figure for the profit is a positive. They made what? A net profit. In the figure, in the year you're having to see a negative, that is a loss. Sawa. So in a business, you can either make a loss or you can make what? A profit. I can be able to see you are still having to, in this case, we've said what? We've said 30 into bracket what? Minus 7. Sawa, Cyprian, it is 30 into bracket minus 7. What this statement means, it is 30 minus 7. Sawa. In mathematics, when you have two negatives, they give you a positive. It will be 30 plus 7. Sawa. It is a negative because in the previous, where we've carried it from, it is a negative. This figure in the bracket where we've carried it from the previous year, it is a negative, and we have to less it further. So when you do that, this statement, ideally what it means, 30 into bracket minus 7, it is 30, because this bracket is already a minus. This bracket, we already have a minus. We add on another minus when you put the bracket. It will be 30 minus 7. So 30 plus 7. Sawa. So it will be like that. It will be like that. It will be like that. Sawa. So I think it is okay. It is okay. So it can either be a gross profit or it can be a loss. So still it can still be a net profit or a loss. When you get a positive figure, it means that is what? A profit. When you get a negative figure, in that we have a negative figure, like the one we have a negative, it is what? A net loss. That's why you're having to say it can either be a net profit or it can be a loss. Where you are having to see a negative in that year, they made a loss. They actually made a loss. So we're having to say in this case, for this statement of financial position, in this case, do what? You'll start with the cost to debt. You'll start with the cost to debt. The cost to debt. So this cost to debt, you already have them. So in this case, you have 80, 170, and 220. 220. Then you'll add on gross profit to debt. Add on gross profit to debt. Gross profit to debt. This one you'll actually get it from the income statement that you've actually been able to prepare. The gross profit to debt, in this case, we have 20. You have in this case 20. Then you have negative 7. Then we have in this case 30. I think it is 30. We have 30. Then cash received to debt. So you less the cash they have received to debt. Cash received to debt. This one, I think it is actually in the question. So we have in this case cash received on the contract in the year. So they're having to give us what? Cash received in the contract in the year. Cash received in the contract in the year. But now we want what? To debt. Sawa. So it means in this case for this year, it will likely be 80. It will likely be 80. Then in the second year, it will be what? In the second year, it will be 170. JB what? You need to say something, JB what? Do you know how we are getting 170 JB what? JB what? JB what? It will be 170 because it is what? To debt. So it is 80 plus what is in the second year in the question, which is actually what? 90. So it means it will likely be 170. Then in the final year, it will likely be 170 plus 70. It comes to 240. 240. 240. 240. So this one you're having to less. This one you're having to less like that. So you're having to, in this case, less like that. So for this one, it'll likely be 100. So this one is 20. For this one, it is negative 7. Because this one and this one go. This one is 250 minus 240. It is actually 10. It is actually, in this case, what? 10 like that. So therefore, in this case, we'll have a work in progress. Work in progress of this much. We'll have a work in progress of that much. A work in progress of that much. Then we can, in this case, go to the receivables. We'll start with the billings to debt. Billings to debt. These ones, they're actually in the question. So you've been told billing made during the year of the contract amounted to 90, 100, and of course, what? 60. So in this case, we have, in this case, For the first year, it will likely be 90. Then in the second year, it is what? The billings to debts. In the second year, it is how much? Joseph, in the second year, the billings to debt is how much? I can see Mutai says 190. Angela says 190. 190, 190, 190, 190. So you people are saying 190. So the eyes have it. The eyes have it. We don't have anything to do. The eyes have it. Then in the final year, it is what? Irene Chebet. In the final year, it is exactly what? In the final year, it is what? Francisca. Mwaka ya mwisho ni ngapi? In the very, very final, it is how much? The billings to debt, it is 250. So I think you're having to understand what you're having to do there. That is very good. Then in this case, we list the cash received to debt. Cash received to debt. I think these figures are happy here. Less cash received to debt. These figures are just here. You just pick them. So this one is 80. This one is 170. This one is 240. 240. So in this case, we'll be able to have our accounts receivable because all of them are ideally going to be positive. This one is 10. This one is 20. This one is 10. So like that. So we would have actually been able to complete our statement of financial position extra. So there's something you can be able to realize. This figure is same as this one. So the work in progress that was there, which they have not actually completed when the contract was coming to an end, it means it was not paid by the client. So it basically remains to be what? To be an accounts receivable. It remains to be an accounts receivable. It remains to be an accounts receivable. Kindly explain how you are getting 240. 240 where? 240 where? This one. This one or which one? Which 240? Is it here or on the other statement? Is it here or on the other statement? Is it here or on the other statement? 240 and 250. 240, these two figures. This figure is here. Cash received to debt. Less cash received to debt. This figure is here. Exactly there. This is the billings to debt. These billings to debt, you are dealing in this case. If you look at the question, Evans, if you look at the question, you are told the billings made during the year on the contract. What figures are you having to see? You're having to see 90, 100, and of course, what in this case? 60. So in the first year, the billings, remember in this case, it is what? It is to debt. You can see this term. To debt. Underline that term. Underline that term. So remember what you've been given in the question is for the year. But you want what? To debt mpaka sai. Mpaka sai. Yani umebill client wako 2023 ulimbill 10 million. 2024 ukambill 30 million. 2025 ukambill 3 million. Sasa to debt mpaka penye tuko sai huko nyuma, ukirudi nyuma ukiendelea, umekuwa ukimbill mpaka umefika ngapi? To debt. Kwanza uanze kumbill to debt. Umembill ngapi? So umembill 90. Then in the second year you can bill 100. So you accumulate 90 plus the 100, 190. Then in the final year you can bill ngapi? 60. 190 plus the 60 imefika 250. Hope we are together. Hope we are together. Evans. 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 You need to confirm very fast whether we are together, because that is ideally how we are having to get the figures. Yes, that is how we are getting the figures. We are basically to debt. To debt, to debt. So like that. So you need to be able to, in this case, check on those particular figures very, very carefully. So those figures actually very, very carefully. Those figures very carefully. Those figures very carefully. So I think that's it. That's it with this particular area. I want to just to give an assignment, which in this case you should actually be able to try. You should be able to try during the weekend. You should be able to try during the weekend. During the weekend, I want to give you an assignment, so you should be able to try during the weekend. You should be able to try during the long weekend. During the long weekend, you should be able to try during the long weekend. So look at these questions. Look at these questions. What is Joshua asking? At I can see, what does it mean if the work in progress in 2016 is not equal to the account receivable in 2016? So it cannot happen. It has to be equal. It has to be equal. Sawa sawa. It has to be equal. It cannot happen. It has to be equal. It has to be equal. If there's, in this case, work in progress carried forward in the final year, if there's work in progress carried forward in the final year, it means if there's work in progress carried forward in the final year of the contract, it is a must. In this case, we'll have what? An accounts receivable, which is similar. Because this work in progress, the contractor never completed it. So he was never paid. So this money is still outstanding because he never completed this work. So it has to be equal. It can never be unequal. It has to be equal. It has to be equal. So that is what is very important. So you can try these ones as assignment. Then I think we'll be able to look at them. So we have, in this case, look at these questions. May 2014 as assignment. This is assignment. So May 2014, question 2C. Question 2C. Then also try to look at this one, May 2019. I don't know if it's May 2019. I haven't seen the question specifically, but just look at it. Question 4. May 2014, question 2C. Then May 2019, question 4. This one I'm not quite certain about it. I don't know whether it is the entire question or it's the part of it. But just have a look at it. But start with this one. So May 2014, question 2C. Then May 2019, question 4. Question 4. They're actually, in this case, on what? Long-term contracts. It's long since they tested this particular area. So the chances are quite minimal they might end up having to test in the exam. But you know it is part of the syllabus. So we don't want a circumstance whereby you say that you are never taught. We were never taught this one by Mwalimu. So it is part of the syllabus. We are required to look at it, but they rarely test contracts. So I want us, in this case, we look at another area now, still under topic number 2, hire purchase contracts. I want us to look at hire purchase contracts, accounting for hire purchase contracts, accounting for hire purchase, accounting for hire purchase contracts. Accounting for hire purchase contracts, accounting for hire purchase contracts. So when you talk about, in this case, a hire purchase contract, this is an agreement or a contract between two parties. One of the parties is actually known as what? The owner of the goods. The owner of the goods is known as the owner of the goods, while the other party is known as what? The hirer. The hirer. So there are two parties under this kind of what? Of a contract or agreement. One of them is the owner of the goods. The other party is known as what? The hirer. Which kind of agreement is this? This person we are calling the owner actually ideally conveys the right of use of what? Of an asset or maybe goods to a person we call what? The hirer. The person we call what? The hirer. Who luckily in this case end up having to pay what we call what? Installments on the goods. Usually in this case, there could be an option whereby after the end of the term of the hire purchase contract, this hirer might have the option of ending up having to do what? Purchase, fully purchase, or acquire what? The goods. So in a contract of hire purchase, there are two parties. We have the owner and the hirer. It's a kind of an agreement where two parties we are calling the owner and the hirer. This owner conveys the right of use of what? Goods or property in goods, or maybe in this case what? Assets. To a person we call what? A hirer. Within this case, this hirer having to pay a consideration in this case, which we call what? Installments. Usually, ideally, there's usually the option of this hirer having to do what? Eventually buy or acquire the goods. So our main focus here ideally will be for us to be able to look at how will this owner account for this kind of contracts. Whenever in this case, for example, it happens he has sold what? Goods on hire purchase to his customers. eventually we'll be able to discover that this owner will end up having to account for these hirers like debtors. He'll account for them like what? Like debtors. Because this hirer ideally owes him some money. Maybe they had actually agreed. He could be able to make what? Maybe down payments. Then installments have to be paid. His installments ni za kudai. Every month analipa, in this case 60,000 up to the end of what? The year 2025. So it means he has paid up to the month of April. But now what is actually ideally remaining after that is a debtor kind of, in this case, what? Arrangement, or an accounts what? Receivable, or an accounts receivable, or an accounts receivable. So that is basically, in this case, what happens under a hire purchase agreement or contract. So before, in this case, we look at how we do the mathematics and the kind of accounts, in this case, we end up having to prepare, whereby we've already been able to say that this hirer will end up having to be like what? A debtor to the owner. Then sometimes, in this case, this owner might face some kind of, like, in this case, what? Risks or maybe challenges. Maybe in this case, aliuzia huyu jamaa goods. Akamwambia, mimi naishi wapi? Mtopanga, Mombasa. Naishi Mtopanga, Mombasa. Akampelekea goods. One day, he basically wakes up and realizes that in this case, this person is actually completely what? Mteja, or maybe in this case is not able to do what? Maybe pay for the goods. So there could be that risk that in this case, this person might fail to do what? Make payments. He might fail to make what? Payment of the installments. So it means if this is the case, then this owner will end up having to do what we call what? Repossession. Will do what we call repossess back the goods, because huyu jamaa ameshindwa kulipa hii 60k maze, imemlemea. So kutakuwa aje? So dependent upon the agreement, he can actually end up having to do what? Repossess. So if it happens he has done repossession, how does he actually end up having to account for these repossessions in his books of accounts? That is ideally also what we'll be able to do what? Discover through the accounting of what? Hire purchase contracts. Hire purchase contracts. So we can, in this case, first of all, try to understand a few concepts about hire purchase. Then in this case, you can go to what? The mathematics part of it. The mathematics part of it. The mathematics part of it. So in this case, we can start with what? Definition. You can write definition. You can write definition. Definition of what is a hire purchase contract. Definition. Definition. You can start in this case with what? Definition. You can write, it is a transaction which allows, it is a transaction which allows, it is a transaction which allows for the acquisition, it is a transaction which allows for the acquisition, it is a transaction which allows for the acquisition of an asset by paying for a deposit. It is a transaction which allows for the acquisition of an asset by paying a deposit, by paying a deposit, by paying a deposit, and taking possession, and taking possession, and taking possession of the asset immediately, and taking possession of the asset immediately. The deposit is paid, and taking possession of the asset immediately, the deposit is paid. Immediately the deposit is paid, full stop. The remaining amount on the hire purchase, the remaining amount on the hire purchase price, the remaining amount on the hire purchase price, the remaining amount on the hire purchase price will be settled installment wise. The remaining amount on the hire purchase price will be settled installment wise. The remaining amount on the hire purchase price will be settled installment wise. The remaining amount on the hire purchase price will be settled what? Installment wise. Therefore, you can be able to write, therefore, you can be able to write, therefore. You know how you write therefore? Cyprian, do you know how you write therefore? It is normally like this. You don't have to write the word. You don't have to write the word. Therefore, you write therefore like this. You write therefore like this. You can be able to write therefore like this. Then you write hire purchase price, hire purchase price, hire purchase price is equals to higher purchase price is equals to deposits plus all installments is equals to deposits. You add on all the installments, plus all the installments plus all the installments plus all the installments, Alternatively, this higher purchase price, this is how it is normally gotten. This is higher purchase, this is how it's normally gotten. You can say higher purchase price is equals to the cash price plus some kind of, like in this case, what, an interest. So if you realized in this case, the cash price is always lower than the higher purchase price. If in this case, it is a motor vehicle that is having to be sold by a car dealer, if someone ends up having to buy the motor vehicle on cash basis, he might pay, in this case, 2 million. If someone buys on higher purchase, because he's having to pay mdogo mdogo, you might find that in this case, it could actually end up having to accumulate to what, 2.5 million. 2.5. So the higher purchase price always is normally higher than the cash price, because there's what, an interest. It's like you've lent this guy money, so you like charge interest. You know, in this case, amekuja akakopea deposit ya 500, amebaki na 1.5. Hii 1.5 alifaa kukulipa immediately, but yeye ni kama amefanyia bizi zingine, so unamchapa interest, then unamwambia badala ya kunilipa 2 million itabidi umenilipa 2.5. So tuna agree the remaining 2 million utakuwa unalipa every month. In this case, how much? 100 for 20 months. So it's like in this case, there's normally an interest charge on the cash price to get what, the higher purchase price. So the higher purchase price is always higher than the cash price. So these are also, you can be able to get it. So on the cash price, we charge on some kind of interest. Then we eventually see what will be the higher purchase price of the goods that we're having to sell to what? To the hirer. We're having to sell to the hirer. We're having to sell to the hirer. So that is what will likely end up having to happen. You can be able to write another statement. A hire purchase transaction involves two parties. A hire purchase transaction involves two parties, i.e., the owner of the goods. A hire purchase transaction involves two parties, i.e., the owner of the goods and the hirer. A hire purchase transaction involves two parties, i.e., the owner of the goods and the hirer. So it normally involves two parties, the owner of the goods and, of course, what? The hirer. The owner of the goods and the hirer. And the hirer. The owner of the goods and the hirer. The owner of the goods and the hirer. The owner of the goods and the hirer. So we can have a break of 5 minutes. Just a break of 5 minutes. Then when we come back, we are going to proceed. A break of 5 minutes. Yeah, so I think we can now continue. So we can now continue to wind up the class. We should be able to wind up in a few. We should be able to wind up in a few. So we can, I think, continue. So you can write in this case a heading. You can write a heading, the methods of accounting for hire purchase contracts. The methods of accounting for hire purchase transactions. You can write a heading, the methods for hire purchase transactions. So the methods of accounting for hire purchase transactions. So you can write the first method. You can write the first method, the methods for accounting for hire purchase transactions. So you can write the first method. You can write interest method. You can write interest method. Interest method. You can write interest method. Interest method. Then you write this under interest method. So under this method, comma, sales are recognized at cash price. Under this method, sales are recognized at cash price. Sales are recognized at cash price. Cash price. Sales are recognized at cash price, full stop. Under this method, sales are recognized at cash price, full stop. Then you write, interest is computed separately. Interest is computed separately. Interest is computed separately. Interest is computed separately and considered as an income. Interest is computed separately. Interest is computed separately. Interest is computed separately and considered as an income. And considered as an income. As an income. So what will be happening here, the owner of the goods who is involved in hire purchase transactions, when he's basically recognizing the sales, he will recognize them, of course, at what? At cash price. Remember, Angela, remember I've been able to tell you that hire purchase price can be equal to, in this case, cash price plus what? Interest, plus some interest on it. So what happens here, the owner of the goods, ideally, he'll just sell or recognize the sales at this price. But now the interest that will be able to raise it to a higher purchase price, he'll now recognize it separately as an income. He will recognize it separately as an income in the books of accounts. That's what in this case it actually means. So interest is computed separately and considered as what? As an income. Then we have method number 2, the sales method. So sales method. Sales method. The sales method. The sales method. The sales method. Then you write this about the sales method. Under this method, sales are recognized at higher purchase price. Under this method, sales are recognized at higher purchase price. Under this method, sales are recognized at higher purchase price. At higher purchase price, full stop. At higher purchase price, full stop. Higher purchase price, full stop. At higher purchase price, full stop. Therefore, you can be able to write, therefore, comma, the gross profit, therefore, comma, the gross profit, therefore, comma, the gross profit is equal to, therefore, the gross profit will be gotten like this. You'll be able to take the higher purchase price, you minus what? The cost of sales. So higher purchase will be equal to higher purchase price. You minus, in this case, what? The cost of sales. The higher purchase price. You minus the higher purchase price. Higher purchase price minus the cost of sales. Minus the cost of sales. the gross profit will likely be equal to higher purchase price minus the cost of sales, minus the cost of. So this factor over the benefits here will have already been catered for in the higher purchase price. But here you can be able to see we are separating it. We are separating. But here it has already been catered for. It has already been catered for inside here. So it will basically, in this case, cumulatively bring an income still because you'll get what the gross profit. So you don't have to, in this case, put it separate because this gross profit here already contains this interest as what as an income already. So in this case, we just recognize the sales at the higher purchase price, then we less the cost of sales that we've actually been able to incur on these goods, then we can be able to get what the gross profits when the goods are actually sold on what on higher purchase. So we can write another small heading. So in this case, accounts prepared under the sales method. So accounts prepared under the sales method. So write another heading, accounts prepared under the sales method. Write another heading, accounts prepared under the sales method. So accounts prepared under the sales method. Accounts prepared under the sales method. Accounts prepared under the sales method. So the first account here is what we call the debtors account. Is what in this case we call what the debtors account is what we call the debtors account. So this is like a heading. So accounts prepared under the sales method. So we'll have in this case what we call the debtors account. So debtors account. The first one is the debtors account. So you can write number one. Account is the debtors account. And of course, it will be able to look like this. We'll have the debtors account. It will likely look like this. Debtors account. It will likely look like this. It will look like this. So we can have in this case the balance brought down. So you can have balance. You can have the balance brought down. You can have the balance brought down. So balance brought down. So then we can have the sales that you've actually made on higher purchase, or sales on higher purchase. The sales you've actually made on higher purchase, you can add them there because they'll increase the debtors. You know, when you sell on higher purchase, you've not been paid the amount in full. Utakuwa unalipwa pole pole, si ndio? So it's like a debtor. That higher becomes like a debtor. So it basically increases the debtor's account in terms of what higher purchase sells. So when you sell on higher purchase, you haven't received the real cash. So that higher becomes a debtor. That's why I was having to tell you, like in this case, the higher becomes like a debtor in the books of what of the owner. So it means in this case, he'll likely be recognized as a debtor because this amount is yet to be received. So when you make the sales on higher purchase, you basically add to the debtor's account. So when the amounts regarding debtors are having to increase, you debit them. But now, eventually, these hirers, they start having to pay you. You sold them to them on higher purchase, but they start having to pay you. When they pay you in this case, you likely credit. So you can actually end up having to receive some cash. So cash received, you can actually end up having to credit to reduce this balance. Then in this case, some of them, we've said, wale wako Mtopanga Mombasa. Wale wako Mtopanga Mombasa, unaweza pata wamefunga mlango na wakapotea na goods zako, imagine, na wako mteja hawapatikani. You will never recover that money. So they become bad debtors. So some of them can be bad debts. You will never recover them. You sold to them, wako Mtopanga, na huko Mtopanga wamezima simu. Ukaenda kwa Mtopanga hapo, ukapata kwamba in this case, hawapatikani kwa mlango yao. So they are not there. So you will not be able to recover this money. So you write it off from this debtor's account. So you'll never recover them. Then sometimes we've been able to say, of course, unaweza pata wako hapo Mtopanga, lakini wameshindwa kulipa. Tumesema unaweza fanya kitu inaitwa nini? Repossession. So you had actually sold to them already, but una repossess, unarudi unakaa nazo maze. Sasa hiyo installments zingine hawatalipa. Nilikuwa nimeuzia 100M na wamelipa tu 2M. So hata kama nilikuwa na expect wanipea 100M hapa, hawatapata. So in this case I have repossess. So repossession. you can repossess these goods sometimes. So repossession basically reduces what? This amount. So repossession, you actually repossess. There can be what you call what? Repossession. So then those are part of the key figures. Then in this case, you can actually be able to have what? The balance carried down, the balance carried down, like that. And of course, you do what? You close your account. You close your account like that. You close your account. You close your account. So that's how in this case, like the debtor's account can end up having to do what? Appear. It can actually end up having to do what? Appear. So number two, we have in this case what we call what? Repossession account. Hope you've been able to complete writing this one. Are you done writing? Because I want to rub and write another account. I want to rub and write another account. Cyprian, are you through? JB what? John Mutua. Michelle Aburili, are you through? So I can see you're saying yes. So we can look at another account. So that is number one. We can look at account number two that will be prepared to assist in this accounting. Account number two that can be prepared to assist in these manenos, in these manenos. We can have in this case number two, what we call the repossession account. Number two, repossession account. Repossession account. So repossession account. So the repossession account, in any case, you're having to do what? To repossess the goods. You're having to repossess the goods. So you'll end up having to repossess whenever in this case you have what? An outstanding balance. So we can start with the shillings. Start with the shillings. So in this case, in the repossession account, you'll in this case start with what was the outstanding balance from this higher. So the outstanding balance. Outstanding balance. Ile pesa haja kulipa. Tumesema kwamba in this case, huu mteja wetu mwenye ako Mtopanga, tulikuwa tumemsupplyia 100 million. Mazei amelipa tu 2M. Na akabaki na 98 million. Sinamaanisha in this case, hiyo amount yenye imebaki ni 98. So that is what we'll be able to put here. So the outstanding balance in that repossession account. So that is the outstanding balance that you haven't been able to recover. You haven't actually been able to do what? Recover. Remember, this one is ideally what you've actually ended up having to do at credit. You've ended up having to do at credit in that debtor's account. Ile credit ulikuwa umeweka unakuja tu unaweka hapa. The amount you in this case you never recovered. So that is the outstanding what? Balance. Outstanding balance. Then these goods that you've actually been able to repossess, you might revalue them. There can be a revaluation. Reducing these amounts, they can be able to, you know when you get them back, you can actually get them back, but of course the value won't be the same. You might not end up having to sell them at 98 million. So ulikuwa umemuuzia 100 million, akakulipa 2M, ikabaki maze, in this case 98 million hajakulipa. So hiyo iko outstanding. But remember, ulikuwa umemuuzia sofa set. So you had actually sold to him what? A sofa set. He's not able to pay, so he has returned it back. But hiyo sofa set, ujua hapo Mtopanga kuna mapanya sana. So they have already eaten the sofa set. So the value is not the same. So even if in this case you end up having to sell it, you can't sell it at 98 million. Vile kunaenda, hizo mapanya inakaa ni hatari. So you might end up only having to sell at what? 60. So you can see in this case, you have to revalue them. Even if you have to sell the sofa set again, you have to revalue it. So there can be that revaluation that in this case will actually end up having to be there. So in this case, you can actually end up having to credit it there. Then what is the profit you haven't realized? So there can be unrealized profit. So of course, this one we'll be able to see how you calculate it. I'll eventually show how we calculate it when you do an illustration. Unrealized profit, which can actually end up having to be there. Then of course, you can be able to balance it off. In this account, you can either in this case have what? A gain on repossession. So a gain on repossession will likely be this side. Or you can have a loss on repossession. These will be these are the balancing figures. So you can be able to put here balancing figure. This is the balancing figure. So if it happens, this side is more, it will actually be a loss. Sawa. If it happens, this balancing figure is this side, it will actually be a gain. Sawa. These are the balancing figures. There can be a gain on repossession or there can be a loss on what you've been, like what you're having to say here. You can see it as reduced. So it will bring about what? A loss. It can bring about a loss, or it can bring about, in this case, what? A gain. So it depends with where the balancing figure is. If it is this side, it is a gain on what you repossessed. If it is this side, exactly what? A loss on what you did what? Repossessed. What you in this case repossessed. What you in this case repossessed. So there's something we've been able to mention here called what? Unrealized profit. So how do you get, in this case, these unrealized profits? How do you get these unrealized profits? Unrealized profits. There's a formula for that unrealized profit. How do you get these unrealized profits? That Mwalimu has just said in this case, he will show you maybe when you do an illustration in our next class. So unrealized profits, you can just write down after the account. You can write unrealized profit, unrealized profit is equals to, unrealized profit is equals to, you take these outstanding amounts. So outstanding, you take outstanding, you take the outstanding amount, I don't know whether it will fit here. You divide by the higher purchase price, multiply by, in this case, the gross profit, multiply by the gross profit. Multiply by the gross profit. So this is how you get the unrealized profit. So you take the outstanding amount over the higher purchase price, multiply by what? This is like a percentage or like a ratio. So you'll be able to get what we call what? The profit you haven't, in this case, been able to realize. So there was a profit you're having to expect when you sold it at 100 million. But now that he has returned, having paid only 2 million, you haven't realized the profit on this amount. You haven't realized the profit you're having to anticipate. So you have to calculate it, and of course, you'll be able to credit it here. So it will likely be outstanding amount over the higher purchase price multiplied by what? By the gross profit. We've already said in this case, Cyprian, we've already said, how do you get the GP? The GP is equals to what? GP. We've already said this one. You already said this one. We said in this case, the GP is actually equal to what? Higher purchase price minus what? Higher purchase price minus the cost of sales. Minus the cost of sales. So that's how you get this one. This one is this higher purchase price. This is the outstanding amount. Iyo jamaa mtopanga akulipa. Iyo jamaa mtopanga akulipa. Iyo ndio the outstanding amount, Then with this unrealized profit, then there can be an account. Which in this case will end up having to help us to know what will we end up having to present in the statement of income, as in this case, what's the unrealized profits, which in this case we've suffered. We've suffered unrealized profit, which you had already recognized. You had already recognized our profit on this 100 million. But now amekurudishia, so kuna profit uja realize maze. So lazima uingoe. Remember, in this case, when you are coming up with the full income statement for the entire business, you had recognized this higher purchase price. It is already included here. That profit is already included here. But in this case, you haven't realized it. So you have to, in this case, eliminate it. You have to eliminate it in what? In the income statement. You have to eliminate it in the income statement. And therefore, in this case, we can have, in this case, another account we call the provision for unrealized profit account. Unrealized profit account. The provision for unrealized profit account. So like that, so like that, so like that. So in this case, we'll have shillings. We'll have, in this case, shillings. And of course, already we've been able to make that computation. We've already been able to make that computation. So this is unrealized profit here, which goes to the, you can see it is on the credit side of the repossession account. So you'll bring it here. It'll be debited here because it is like an expense. You know, in this case, if you have unrealized profits, this is like an expense. So you basically debit it here. So you'll have here repossession. That is the double entry. You credit it in the repossession account, but you debit it here. You likely debit it here. Then you close this account. When you close this account, you're basically closing it into what? Into the income statement. You're actually having to close it in the income statement. But again, in this case, maybe there could have actually, in this case, been a balance brought down. So you have to put, if there was any balance brought down in this account, you have to put it there. Then in this case, you can be able to have the balance carried down at the end of the year. You can be able to put, if you're told it was there, then you'll be able to close the balancing figure in the income statement, which basically in this case will be an expense. So it means if it is actually credited here, it will go on the debit side of the income statement, and therefore in this case it will be what? It will be an expense, because all expenses are normally done what? Debited in the income statement. So in that case, we don't have these figures. It means we'll just pick this figure the way it is, because it will be the balancing figure here. It will be the balancing figure there, and therefore it will be able to go to what? To the income statement as an expense, which in this case they'll end up having to suffer as what? As owners of the goods, as those who are having to deal with what? Higher purchase goods, higher purchase goods, higher purchase goods, higher purchase goods. So I think those are some of the key accounts that in this case, we actually end up having to do what? Prepare. So we are going to end the class there. And of course, in our next class, we'll be able to look at a particular illustration regarding hire purchase transactions. This is also a very rarely tested area in the exam. It's very rarely tested, this one. But you never know. You know, these 𝐶𝐻, sometimes they just surprise us. Sometimes they just surprise us. You never know. You never know. Sometimes they just surprise us. So you have to just read this question. Don't do anything about it. It's not an assignment. So don't do anything about it. November 2017, just look at it. November 2017, question number 5B. Don't do anything about it. I'll be able to show you in class how we'll be able to solve it. I'll be able to show you in class how we'll be able to solve it. But remember, there's an assignment I've given, so don't start having to say today there's no assignment. There's that assignment for what? For long-term construction contracts, which I've already been able to give earlier. You have to attempt it over the weekend, and you can be able to share. So that in this case, we can be able to see how is the progress. How is the progress? So you don't have to worry you'll make a mistake. You don't have to worry you'll make a mistake. So in this case, what you need to do, you basically, in this case, you need to try. So the more you try, you make a mistake, you are corrected, the more you learn, and it sticks. The more you learn, and of course, it does what? It sticks. The more you learn, and of course, it does what? It sticks. So I think that's it. That's it. So let's end there. So unless there's a burning question you can be able to ask, unless there's a burning question you can be able to ask, take note that in this case, we are actually in topic number 2. We might end up having to complete topic 1 and 2 very soon. Topic 1 and 2 we are going to complete very soon. So after that, we'll go to the most commonly tested topics. After that, the most commonly tested topics, after that, we'll be able to go to them. After that, maybe from next week, I think Thursday, we might have moved to topic number 3. We might have moved to topic number 3, or Friday. And I think next week, Friday, we would have moved to topic number 3, because I'll be able to complete topic 1. There's an area remaining in topic number 1. I think 2 areas, which I had not covered. I'll try to see whether I can be able to complete them on Tuesday, and of course on Thursday, together with another area known as what? Foreign exchange in topic 2. Then we see whether we can be able to start topic 3, maybe next week, Friday, or maybe the other week. Maybe the other week, like that. So that is what is happening. So if there's no question, then I think we should be able to end there, and people should start enjoying the weekend. People should start enjoying the weekends. So you can have a good night. Let's catch up on Tuesday. Attempt the assignment. If you share, I'll be able to have a look at it. If you share, I'll be able to have a look at it. So you can be able to have what? A good night. A good night. There are how many topics? I think we'll be able to share the syllabus on the group. You'll be able to see. I'll be able to share the syllabus there. You'll be able to see. So that is okay, Evans. Sawa. So you can have a good night.